So my name is Natasha Phipps. I am the CEO of WealthShare, and I'm joined this evening by my two co-founders, Monique Verlan and Rodney Phipps. So they may jump in with some wisdom as well here this evening. But this topic is something that we are very passionate about talking about, and I feel is not being maybe addressed enough by leaders in the industry, and is something we're probably going to even expand upon over the next year, this topic of how to analyze passive opportunities. And to be very honest with you, we've learned a lot building WealthShare in the last few years. And so the questions I would ask now, I don't know how else I would have learned them other than, necessarily going through this. So I want to share that information that we have learned, because I do think it is valuable and helpful. But it is just a starting point. And, we could expand upon this for a whole book, I'm sure. But I hope this does provide a bit of resources to you to get started. As always, we love to do these events to be as, sharing as we can with what we are learning, but also what the industry is experiencing at certain times. So this is a really good example of that. 2024, I know, has brought a lot of hardships for a lot of people in the passive investment space, in the peer-to-peer lending space in particular. And it can be a difficult thing to talk about, but it's important that we're learning from things that are going wrong and how we can do better, and what we as investors and capital raisers need to be understanding if we are in this space. So that is the goal of this evening. I will go through the kind of presentation of this, and then I'm also going to pull up the guide that we wrote to kind of accompany this. And I hope to expand upon this into next year. But this is kind of the first sort of draft and look at this that we are sharing with you this evening. So we're going to get started. So before we get started, I always have to share our lovely disclaimer. Anything we do discuss here this evening is not a solicitation for your investment. This is for informational purposes only. I love the thumbs up there, Susan. Looks awesome. So just keep that in mind. If you do want to review our full disclaimer, you're able to do so at wealthshare.ca. And happy to have questions as well. Maybe we will kind of save them towards the end, because I might cover some of the things that I know come up frequently. But please put your questions in the chat if you're worried about forgetting them. I absolutely want to know them, and we will talk about it at the end. So as I said earlier, I am joined by my co-founders here this evening, Rodney and Monique. And yeah, we're excited to have you here. Especially, I know, as we're approaching holiday season, these evenings can start to get pretty busy. So let's jump into it. I think when I first started thinking about this topic, I started thinking about, what does the term mean when people say passive investing? And often I feel, when I go to a lot of conferences and events, now that term is almost, people think a lot of just private lending, when there's a vast array of passive investments out in the world, and they're not just to do with real estate. There's all kinds of passive investments, but I think it's important to understand what these things mean. And private lending is very different than private securities, and they do not necessarily have the same oversight and regulations that a private security might. So that's some key concepts I think we need to start using in our language a little bit more. WealthShare is a private security. We're a private REIT here in Canada, and we do abide by all of these securities laws here in our country. But that's very different than, say, Monique and I go, okay, we're going to do a joint venture between you and me, and we're going to hopefully have an agreement. There is no one calling Monique or I and checking, did we do our paperwork right? It's solely, peer-to-peer. We're hopefully are getting a lawyer to review it, but not necessarily. And I hear that a lot. And lumping that in with buying, stocks or private securities or trust units with WealthShare is very different. There's a whole lot more oversight that goes into that to protect you as the consumer, ultimately, at the end of the day. So two very different things, both have their uses and purposes in the space, but two very, very different things. So that is a good kind of first thing to consider. Now, this slide is something we have put a lot of thought into, how to kind of like address the volatility in the market. And if you're not familiar, I will quickly bring it up. But this year, there has been a lot of promissory note debacles, to put it that way, out in our real estate investing community. There's been hundreds of millions of dollars have been lost in this space, and a wide range of, how that was done and why it was done and whatnot. But what is common by a lot of it, not all of it, but I would say the majority, is all of these people who were investing, looking for, a stable, slow, stable monthly return. They're often being attracted to unsecured promissory notes. And those funds are being used for projects or renovations or whatever it might be. And what the three of us started thinking about was, that's like the whole reason we invest in real estate, is to have the security. So why are we giving up kind of the largest edge that real estate has? You don't have that edge with crypto or other, types of investments. It's what makes real estate great, is the security. It is the real estate. It's the buildings we can see, feel, and touch. And so for these types of investments where it's peer-to-peer, one piece of paper, very simple type of paperwork, there is often no security element. So there is no real estate securing your investment. And that's what we really want to kind of, shout from the rooftops here is why would you give that up? Why would you, give up that large edge that real estate has, which is your security? So hopefully that gets some wheels turning. This is possibly the most important slide of this entire presentation, and I think where not just investors need to take a step back, but also people in the capital raising community. Just because you are raising money privately does not mean that securities laws do not apply to you. They definitely still apply, and they need to be understood. And in Canada, there's two main classifications for investors. One is eligible investors, one is accredited investors. And those definitions are easily found, but what they have to do with is an individual's net worth, their income, or the assets that they hold. And depending what that looks like for you will determine which one that you are, eligible or accredited. And a lot of the people who got caught up in these unfortunate stories, I have found, at least the ones that I have spoke to, often are not accredited investors. And the risks that they are taking with these unsecured type of investments, honestly, according to the definitions in this space, should be reserved for accredited investors only. And the reason for that is an accredited investor can recover. They can hopefully recover a little bit better than a eligible investor. So they have more to lose. And that is why there is a difference. And this goes hand in hand with when we started WealthShare, we did not take the quickest, easiest, or cheapest path to build WealthShare. We took the longest and the most expensive path. But that was because we wanted to appeal to as many investors as possible. We wanted to be able to raise capital from not just accredited investors. There's plenty of opportunities for the already wealthy in this country, and we want to appeal to everyone. So the structure that we have in place is the only way to raise capital, to have the corporate structure that we do in combination with a offering memorandum to raise capital, is the only way to legally raise money from eligible investors in Canada. You have to have an offering memorandum to be doing what we are doing. And so that's not something that is, I don't think, widely understood. And these eligible investors also, often why they were attracted to the promissory notes, and we've had plenty of investors not invest with us because this is what they're looking for. They're looking for a monthly return. you're looking for cash every single month, which often means that the money is being invested from a line of credit, which isn't necessarily a bad thing. But if you can't carry that line of credit, you're putting yourself at risk. And that's really where I think some, folks run into trouble. It works great when it's working, but then that house of cards can sort of quickly start coming down. And it's important to think about too, if you want a monthly return, there are opportunities out there and there's funds out there who offer a monthly return to you. But think about, where is the monthly return coming from? If there is no rental income, if there is no way that this group is generating income, but they're offering a monthly return, that should be sort of concerning, in that if anything goes wrong or there's issues with budgeting or delays or whatever, that quickly becomes very hard to keep up with. Rising interest rates, all of the kind of challenges that we have seen. So if you want those monthly returns, you have to understand that part of it is, where is that capital coming from? And then spend some time thinking about suitability. And if whoever you're raising, whoever is raising money is not asking questions about suitability, that is a red flag. This needs to be understood from the investor side and the person or individual or company that's raising capital. So this is something that should be on the top of everyone's kind of mind when they're either raising capital or looking at these investments. Which one am I? Am I a eligible investor or an accredited investor? You can Google it if you're not sure which one you fall into, or you want to have a conversation about it. Our exempt market dealers are also here to help with that, to determine what type of investor you are. And when you go and make a profile with our exempt market dealer Atlas Fund, it asks you these questions for this reason. We need to determine what type of investor you are. And that also can determine how much makes sense to invest based on the guidelines here in Canada. So hopefully we can all start thinking a bit more about suitability. Also, just where is this revenue coming from? And from the investor's point of view as well, thinking about, are your sort of like demands, let's say, I don't know what else to call it, but requirements that you want from a group that might be raising money, putting them at risk? Is it putting the project at risk? And if you can't carry the investment, with delays, then that should be a consideration as well. So hopefully that helps a little bit from the suitability point of view. So how can you keep your edge in this space? How can you passively invest while keeping that security that we all want? And don't get me wrong, the security is not everything. It's secure. It gives you something, but if something goes wrong, you still have to do something with that security. But it gives you a starting point of how to have some recourse if something goes wrong. So let's talk about private lending. So private lending typically can mean, promissory note, like we discussed. It also can mean giving someone a private mortgage. So very commonly, investors are using their private funds, whether it's cash or registered funds, to offer private mortgages to other investors for projects or whatever that they may need it for. So this is something that makes sense in that, okay, I can register a mortgage on title. That will give you your security. If you are doing more of a prom note type of situation, you can use a general security agreement, but those are not nearly as good as being registered on title of an asset that has equity. So make sure you are getting legal advice as well with any of this stuff. That was something too that I'm always surprised a little bit, that if we're buying a house, we have to use a lawyer. A lawyer is going to look over everything. A lawyer is going to register everything on land titles. A lawyer or two are going to look at it for sure. But often in this world, there isn't necessarily a lawyer looking at it, but you could be investing just as much money. So why, when we're looking at a piece of real estate for ourselves, which is what inspired this as a investor, is most of us know how to go through the process of analyzing a actual piece of real estate. We're going to get a home inspection. We're going to have our realtors do the appropriate paperwork. We're going to have the lawyers review. We're going to review all the leases. We're going to review all this stuff. And I find it surprising that very often people are not getting a lawyer involved to review documents, to have these conversations about how you can keep security. But often you're still putting down, a similar amount that you would to a down payment on a piece of real estate. So get your lawyer involved to figure out how you can have some security in the deal. You also don't have to have security with the piece of real estate that they might be using the money for. You can secure it against another piece of real estate that maybe makes more sense or has more equity in it or whatever it is. So do your homework on whatever it's being secured to. Number 2 here, joint ventures. So going back 5+ years, I would say joint ventures were the thing. They were absolutely the thing. It was very uncommon then that people were doing this kind of peer-to-peer lending. It was a lot of JVs. And in traditional sort of joint ventures, often what you see is one partner is the financial partner, one partner is the working partner. And that is a common sort of 50-50 deal often, not always, but often. And so everyone kind of has a role in the deal and they have a shared interest in the property. So we've done several of these and it's a great way that everyone has some security. Everyone knows their roles. We have a joint venture agreement outlining what everyone's jobs and responsibilities are. And that gives you your security because that is then secured to the property that you are joint venturing on. So joint ventures are great. Where things started changing though was when the topic of OPM started to become sort of the trendy thing, using other people's money. And certainly you can use other people's money, but I think we missed a step there in learning how to do that with the same level of due diligence we would do as buying that actual piece of real estate. I think that maybe is where we kind of got really excited about that and jumped over that. So hopefully we can, learn from that. So joint ventures, I still love joint ventures, still do joint ventures, actually cashing out a joint venture or wrapping up a joint venture that we've been in for almost 6 years, just in a couple weeks now. And they work great. And I am a huge fan of them. And so, but like anything, there's always fads and trends and everything. So that was kind of the thing. Then the third one is private securities. So your subscription agreement, for example, whether you're investing with a fund like us, could be different for every single fund that you look at. What does the subscription agreement actually mean? We're going to talk about that a little bit more, about key things that I would look for in the subscription agreement. But in private securities, often your risk is limited to what you invest, and there's a whole host of types of investments out there. But your subscription agreement document will outline what is giving you your security in this investment, and that will vary for everyone. For us, what the WealthShare investors love is our investors own our real estate. Me, Rodney, and Monique do not own the real estate. So that's not the case everywhere, though. There's all kinds of different structures out there that could be weighted in the operator's favor. There's all kinds of different things out there in terms of how the operators are being compensated and what their kind of skin in the game is as well. So our investors love that, like that 100% of this is owned by our investors. So that's huge security. So those are a few things to kind of think about, is how can you keep your security? Talk to your lawyer about that, because obviously there's different things in different provinces. This isn't necessarily legal advice. It's just things to be thinking about. So kind of some key kind of 5 things here in how to actually analyze the passive investment. So we talked about security. Ideally, you are getting legal advice with this. So number 2, the team. This is really, really important as well. We often hear, especially when we were first getting started, like, oh, you're only projecting 8 to 12%. Like so-and-so over here is projecting 24% or 26%. And they have never executed what they're trying to do. we really wanted to walk before we ran here. We have all been landlords for decades. We've all been investors for decades, but operating a fund, operating a larger venture like this is a very different undertaking than managing my own property down the street, right? And so how we kind of got started with WealthShare was intentional, that we wanted to kind of take our experience, which is as landlords, as investors, and apply that to something that we feel very confidently we can do well at. And often we get excited in real estate, whether we're flipping or we're building a fund or we're doing development. And if we don't have the experience to execute what we're doing, that is something to consider. Who is the people behind this project that you are taking a look at? And are they forthcoming with their experience? There's all kinds of questions you can ask them about that, but does the team make sense for the project that they're trying to execute? That's a pretty good place to start. And are they honest about what challenges they might see too? Like, ask the, questions about the experience, but I love when people ask them, well, what risks do you think you have? Or what concerns might come up? Those types of questions, and see the types of answers that you get. So number 3 is the structure. So this is, we could talk for a whole hour about structure, and there is a wide variety of structures out there. So often if it's passive investments, if we're going peer-to-peer, it's just, individual to individual. If it's a passive investment into some type of subscription agreement or security, often you will find 2 common things out there. So one is a corporation where they're going to issue you shares, and then you'll be a shareholder in that company. Another one is GP-LP structures, so limited partnerships. That's how we actually started with WealthShare. Initially, it was a limited partnership structure. And the challenge we ran into as well was a limited partnership could only take in capital from accredited investors only. And if we wanted to use like the whole structure we have in place, we had to go down this road. So we would be what's called a mutual fund trust, also known as a private REIT. People think these are 2 different things. The mutual fund trust is that. Real estate investment trust is REIT. In combination with the offering memorandum, the mutual fund trust can then accept investment from eligible investors and accredited investors. So understanding the structure is really important, and what risks a structure might have, what pros does it have, because there's also different oversight that comes into play based on the structure. So as we talked about peer-to-peer, there is no oversight. There's no one watching, there's no one checking. Whereas for us, we're at the other end of the spectrum here. Now, if we were a publicly traded company, for example, that would be significantly even higher oversight. But for us, we have to do, for example, annual audited financials, which Monique is neck deep in right now. And that is really, really critical, because once a year, an independent audit tells you as the investor how we've actually done, where every penny has gone to. Whereas if we were just in a joint venture or doing something more direct, that cost wouldn't make sense. So you wouldn't be going down that route for that. So what pros and cons does the structure have? Does it make sense for the strategy that this team is going to implement, right? So that might also take some advice from your lawyer. But what benefits or cons does it have for you as the investor, the actual structure? Number 4 is, what is the exit plan or timeline of the investment, and does that align with what you are looking for as the investor? So exit plan and timeline, does it align with you? But more importantly, what can go wrong with the exit plan and timeline, and asking those questions. So, and there's a whole host of things here, but let's just take kind of 2 examples. So if you are investing in a development project, the first things that come to mind are delays, right? And sometimes they're on time. Oftentimes it could be, there's some that are 7+ years that I'm aware of that are still ongoing, right? So does the exit plan, do you need it to be like finite, or do you have flexibility with that? Does that line up with what you're okay with? what you're looking for. And you do need to think ahead, but then also thinking about the strategy that the company is actually planning for. So thinking about the exit plan and timeline a little bit more. It is real estate at the end of the day. Things don't always go exactly as we plan. Things don't always work out to, the moment and second that we want it to. For us, we are an open fund. So there is no end that is happening. It's not like, okay, we're going to get to this amount and then we're done. That's not how we are operating, but there are some instances or other opportunities out there where it's like, okay, they're going to raise this amount of money, they're going to do this, and then they're closed. So that's not how we do it. We're slowly growing a portfolio over time, but that's not necessarily the case for everyone. So in those ones where they are closing the doors, you might need to act quickly. You might need to make a decision quickly. You might need to know how to analyze these things a little bit quicker. And then the last one here, and then I'm going to talk about actual specifics of some of these things and actual questions to ask. But asking questions, we love getting asked questions. We learn a lot from the questions that people ask us, and we kind of refine how we present things, how we communicate with you guys. So we really, really love questions. But I've been on the other end as a potential investor to some of these capital raisers, which is always interesting. And the pushback sometimes I feel when you start asking questions is sort of a concern. So if you're asking questions and they're not willing to work with you or give you the time, or they don't know and even if they don't know the answers, like, are they going to get you those answers? How do you feel when you are asking questions? And are they willing to cooperate with you or work with you on that? It also shows like how well do they know their product? How well do they know their strategy and their corporate structure and their offering, right? So they should know it inside out and backwards, whoever you're talking to, but ask questions and see how you feel about asking questions. But speaking of questions, I want to use kind of our overview, and then I'm going to dig into the guide about what questions you should be asking about each of these things. So the very first one we talked about was the eligible and accredited investors. And you can ask that, are you open to eligible and accredited investors? Ask that question. That question alone will tell you a lot about the knowledge of the person on the other end. So if this isn't an easy sort of question for them to answer, then that's something to kind of note in your mind, because this should be like they should know this question for sure. And that's not necessarily the case, I'm hearing. So keep that in mind. Question 2 is, what kind of funds can they accept if it's a opportunity that you're looking at? Can you use a combination of different funds? If they are taking registered accounts, which ones? And then in hand with that, if they are accepting registered accounts, which trust companies are they using? So if you are investing registered funds, you do need an intermediary trust company to facilitate the investment. So if you want to use your RRSP and I'm going to loan it to Ryan and we're going to put a mortgage on a property, then we need a trust company to facilitate that. We use Olympia Trust, Odyssey Trust, and Western Pacific. And I like to think that we might have started the trend of offering more than one. I think when we did that, we might have been the first. And I think everybody's doing it now. So because I didn't like how it was like, you have to use this one company and that's it. So we did the work and spent the money to get approved by all of these companies, because we want you to have the choice. We want it to be convenient for you. And occasionally people already have accounts at these places. So it doesn't necessarily makes sense that you force them in one direction. So that's something to consider. And then the minimum investment, of course. What is the minimum investment? Does that line up with what you're looking for? The returns is an interesting one, because obviously it's the first thing we think about often as investors is, what return am I going to get from this investment? But very rarely does anyone ever ask me how these returns are being made. So how are we actually making this money? And that should be a question that you're asking anyone. How are they making the money? What are they using the money for? Occasionally people ask me what we're using the money for, but what are you, how are the returns actually made? And how has that projection been calculated? And can you show me that, right? So for us, we target a 12% annual return. That is made up of equity growth, of the cash flow of the property, debt pay down, of course, the kind of value add in terms of how well we manage these assets that creates the value of the property. And that could be very different from someone doing a BRRRR strategy or something else. So does the strategy they're doing make sense with the returns? But also, the higher the risk and the more variables in the strategy, the return should be higher. Okay, so make sure if you're comparing these opportunities, you're comparing apples to apples. So you can't compare WealthShare to a development fund and then go, why do these numbers look so different? Because they should be very different. They should be very different because the more variables there are, the higher the reward, but the higher the risk. That really should be. So does it kind of make sense? If someone is doing buy and hold real estate like we're doing and they're offering 16 to 18% returns, I know Monique would be like shaking her head because she knows that doesn't work, right? It's really, really, really challenging to try to hit numbers higher up in like a development space with just doing buy and hold real estate. So do those things sort of make sense? And then a good question to ask too is, which I also don't always often get asked too, but like, how much money are you trying to raise, and where are you at in the raise? Those types of questions, particularly if the funds are being used for a project or something, it's important to know that this project is going to get off the ground. How are they doing? Whereas for us, we're kind of growing as we raise. It's not like there's a hard deadline. But if I was doing a big project or a renovation, there would definitely be. So asking those types of questions. And then the last one is for us specifically, because we are a growing open fund, we have an unlimited number of Class B trust units available. So there is no like end door shut type of thing. So hopefully that helps a little bit. The other question to ask specifically about the returns is, what will you see along the way to kind of show how the investment is doing, right? So we talked about how WealthShare does an annual audit. Well, if they're not undergoing an audit, what will they provide annually? Will there be an investor meetup? Will there be financials provided? What are they going to provide? And that will vary greatly based, obviously, on the type of investment that they're doing and what they're going to offer you. So with that, I want to talk about some key questions. And I've already had some of you use these questions out there in the marketplace, which makes me really excited. That's already come back to me already, and I think it's great. So, and there's more, and I'm going to pull up the guide here in a second as well. But these are kind of some key ones. If I had to be like, these 5 ones are really important to ask. So let's kind of go through them here. So number one, and the reason this came to mind, is who is the beneficial owners of the assets? So in the last year, I have had individuals reach out to me that are in a bit of a tough time through some of these issues we have seen in the marketplace, and so they have called and asked for what my thoughts are, and of course, like, I can't get involved. But the one thing that started to come to mind was, oftentimes when I'm hearing this story, these individuals think someone owns the assets. And I go, well, it's very easy to see who owns the asset, right? Here in Alberta, for $10, you can pull title on any property in this province. I think in other provinces, you might need to get a lawyer to do it, but this would still be worth doing before you invest. So if I'm coming to you and I say, I own this piece of real estate and we're going to raise money for it, and this is our plan, no one that I spoke to checked if these individuals actually owned this real estate. So in this case, when I actually pulled the title, it was a different company that owned the real estate that had borrowed the money. So these two things are now very separate. The individuals or monies, or the individuals or company that had borrowed money with promissory notes was using that money for I don't know what, but whoever owned the real estate was not the same. So that's a very easy thing to check for your own knowledge, for your own security, as you're like, okay, checked. Feel free to pull title on the WealthShare assets so you can see who owns them. I would love that, but I don't think this step is being done. And I don't know if people thought to do it. And so I hope this gives you something tangible you can do. I believe in Ontario, you need a lawyer to do it, but it's not a big fee to go and pull the title. Number two, and this kind of relates to like risk mitigation, your security, ideally, if you are especially securing it with some sort of asset, is what type of debt does the asset hold? Or what type of debt does the portfolio hold if there's a group of assets like we have here? And I never get asked this question. I very, very, very rarely does anyone ever ask about the type of debt that WealthShare has, or the mortgages that we have on the assets. And I think that's a fair question to ask. But in the instances where we're hopefully trying to learn from what has happened in the marketplace, what was most shocking to me when I started kind of reading through this information was the amount of money that was raised was several times over what assets they had in place. So if you're borrowing $5 million and you've only got $1 million of assets, that says there's a huge problem. You as the capital raiser really need to consider that, right? If all goes wrong, you do not have enough to pay everyone back. And that was something that was really surprising to me. I would absolutely not be able to sleep at night. But and I'm not saying people went down this road intentionally or they wanted to get here, but this is the reality of where things became. And when you're trying to get out of these situations and interest rates were rising, I can see how people got here, but investors don't know to necessarily ask this question, I don't feel. And so for us in our portfolio, we carry, I don't even think we're at 80% loan to value, Monique. It's high 70s, I believe, on our portfolio, but
yep, I was above the high 70s.
Yeah, so that's and just to go on a little bit of a side tangent here, commonly I get asked about the MLI Select program, and I love the program, don't get me wrong. We have our love, hate, wish lists and all kinds of things like every other investor does. But the loan to value, if everything in a portfolio is highly leveraged, and I think we are going to see some interesting things in the marketplace where these 95% loan to values, and on new construction, it was much easier to get 95% loan to purchase price. But if anything kind of wiggles and wobbles in the marketplace, like there is not a lot of room for adjustment there. And so that goes hand in hand with the next one, which is mitigating risk. And it could be different for other groups and how they are looking at it. But the equity position and the debt position of the asset is a huge thing that should be understood. We're very forthcoming with that information. I don't necessarily know how everybody is, but that's something I think is fair to ask. So that goes well, of course, with the mitigating risk. What is your largest risk? And risk as well will be dependent on the strategy in terms of like what kinds of questions you would ask. But for a development project, I would be looking at, things like, do they have their pricing locked in for construction? What kind of contract do they have signed for the actual construction and building of the projects? What is their game plan if further cash is needed? Is that outlined in the subscription agreement? What does it say if there is cost overruns? What's the plan? And is there a plan as well? The sophisticated developers that are, using the GPLP structure out there in the market have a plan in place in their subscription agreement for this. And they also often share what their plan is in terms of construction costing and what they have agreed upon in their contract. So you can kind of identify where there might be some risk, where there isn't, because it's already kind of locked and kind of ready to go. Another thing for development would be, do they have their permits? And where are they at in the permitting process? Having a piece of land and being ready to put, a shovel in the ground is two very, very different risk profiles in terms of the actual timeline. So if you're investing, the earlier on you're investing, the higher your potential reward could be, but also it's the higher risk. And how we kind of look at risk, or how we like to talk about it too, is like, there's nothing wrong with taking risk. We've all taken risks here. We're all entrepreneurs. We're often all self-employed, and but just have a variable risk, right? Have some higher risk, some lower risk. Diversify your geography and your timelines and your strategy, even in passive investing. So I think in the active investing space, a lot of investors understand that and know that, and they have, real estate in Toronto and in Calgary and in Vancouver, and they have different types of properties. But what I learned this year talking to a lot of people was they put a lot of eggs in one basket when it came to the kind of peer-to-peer lending side of things. So diversify out, spread things out. Don't just put everything in one kind of way to do it. That makes sense. What is the largest risk? I think this is a good question to ask too. So let's even talk about the risk for us. We talked a little bit, a few ideas on the development side. For us, okay, so interest rates are dropping right now, so more tenants are becoming homeowners. I wouldn't say that's a huge risk. I think we still have plenty of tenants, but it is something we're going to see, and we're going to see tenants start to buy more real estate. What if there's, economic factors, and, there's challenges in the economy that affect a certain area? That could be a risk to a city or an area or a province. For where do the people go? The number one lesson in real estate is that where are the people going? And right now we all know there's plenty of people coming to Alberta, but that's not a guarantee. That's not a guaranteed thing. Something could happen in the world, right? So just thinking about what the largest risk is for us, we're buying turnkey buildings that you can see, feel, and touch today. So we don't got to worry about, getting the real estate or getting permits or any of that. They'd be more risks that would be lower risks in our mind, but there is still risk. There could be something, there could be, a flood, there could be things that happen outside of our control. So those are the types of risks that you want to consider, and then have variable risks inside of your portfolio, ideally. Number 5, this is a really, really big question too, is so inside of the WealthShare portfolio, Rodney, myself, and also Monique, we have personal guarantees on our debt. That is a big deal. So we have a lot on the line for our assets doing well. We have everything on the line. And this is something that, I don't know other people talk about the guarantor doesn't necessarily have to be the operator, if that makes sense. So, or whoever's making decisions, they might be listed on there, but there could be other guarantors as well. So who's guaranteeing the debt? If it's commercial multifamily type of debt, there will be guarantors. If it's a CMHC insured mortgage, there will be guarantors. So who is the guarantors? What do they have to lose in it? How much control do they have? I've seen situations too where there's guarantors who don't actually have the control of what is going on. So there's a whole host of different ways the guarantors could be done. But if there is commercial debt, there is guarantors. So, will they be forthcoming with that information or not? And particularly if they're like newer in a certain strategy, it's good to know that the operator, has that on the line, like that they are also guaranteeing this, because that is a massive risk, right? So they are going to be very motivated to ensure things are working out. You also did receive a guide. If you registered after 8 a.m. this morning, I think Joanne said we have to send it to you directly, but we also have a link. I will expand this guide because this is just an initial kind of thought. But what I wanted to pull up was, okay, so, that was the other thing, is asking for referrals. That is a good question to ask as well. Asking for referrals. There is the great thing about, I find, the real estate investing community is the kind of sharing of knowledge. We can easily interact with each other now. That hasn't always been the case. So asking for referrals or who they have worked with before is a fair question as well. And have a conversation with them, right? And also it might just be a good connection for you to know anyways. So ask for a referral. Okay, some key kind of like summary things just to review is your passive analysis should be similar to your active analysis. So when you're analyzing a piece of real estate, you know, and you take a look at, does this property make sense in this area? Will I have good rental demand in this area? Whatever the money is being used for like, do that quick check that it makes sense, right? Does what they are doing with the money actually make sense for the area they're doing it in or whatever it is? You can do the exact same thing, even though you're investing passively, because you have a very good interest in making sure that the project makes sense. So a good example of this, I was actually talking to an investor this week about the locations we choose for Calgary. Buying anything in Alberta isn't a strategy. You have to be still highly targeted, even though there's plenty of people moving to Alberta, right? We all know that. That doesn't mean that it's all created equally. So, you know, what are things I think people should be asking about Alberta right now is, well, are you planning for the slower times, right? Is this piece of real estate going to be in demand when it's a more balanced market? Has historically this been a good rental area, even in the slower markets, right? So right now in Alberta, I kind of joke that everyone's a bit of a genius, but these geniuses who are buying buildings or property with no parking, for example, they are going to get, they're going to regret that. I can almost promise. And there is these pieces of real estate going in that have small studios with no parking, and they maybe work right now, but they are not going to work forever. It is just something that, you know, is a very fair question to ask. Does it make sense in the long run? Okay, suitability. We talked about suitability. Hopefully everyone understands accredited investors, eligible investors, and whether you are raising capital or you're investing, you need to understand these two things. You need to know which one you qualify in. And if you're an eligible investor, don't I think these eligible investors are maybe trying to chase those returns that are really probably better suited because they're higher risk for accredited investors, and are getting caught in that, right? So there's a reason these kind of definitions are there. So suitability should be at the top of everyone's mind. Number 3 is the diversification. Same thing when you're looking not just with your portfolio, but with whatever you are investing into in terms of a fund, for example. I think most of us can agree diversification is a good thing. Same thing within your portfolio. And diversification doesn't necessarily just mean, you know, different types of assets. It could mean different assets, different areas, different timelines, different structures, all of that combined. And that applies on the active investing side and the passive investing side. So being diverse in your investments is really, really critical. Number 4, I have on here too, of do not underestimate your gut check. Listen to your gut, ask your gut, you know, does this feel right? Your gut is always right. Your gut will at least make you ask more questions if you're not comfortable. So listen to your gut. You know, I can't tell you how many times I've heard that as well. Like, I wish I would listen to my gut, or I had a feeling. If you have a feeling, it's there for a reason. So pay attention to it. Number 5, too, just as like a quick sort of takeaways, isn't really a question, but remembering that, kind of tying into the very beginning about why we invest in real estate. Real estate is not going to make us rich overnight. It isn't. True wealth in real estate happens over time, when, you know, years go by, and then you can look back and see how well you've done. If you're looking to make huge gains in a short period of time, real estate might not make the most sense. You might want to go to a higher risk strategy, right? That doesn't offer what real estate offers. So true wealth in real estate, people who have done really well in real estate have done it over a long period of time, and they have been very diverse in their portfolio as well. And hopefully we all know to not be afraid to get a opportunity reviewed. Spending money on the review is not a waste of money. It is money well spent. And I promise you will learn something. I also love when people get our things reviewed because different lawyers, different groups ask different questions, and it's something for us to consider, right? So it has a good effect. You will be informed, especially, you know, if you are doing these kind of smaller peer-to-peer things where there is no oversight. Definitely you need a lawyer involved to create that oversight for you. So definitely work with a lawyer, make sure that you are doing that. You likely would not feel comfortable buying a piece of real estate without a home inspection, without a lawyer, without reviewing the leases. You wouldn't just go, okay, let's just take it. You would do all those things. It's the same thing. You need to do that in place of the home inspection. You're doing this inspection instead. And just a kind of thing, just a little kind of phrase here too, is like, you've worked so hard to save up this sum of money or to have access to this sum of money. So you shouldn't, you know, you should hand it over with that kind of type of mentality, right? And it's interesting that I feel people do that on the hard asset side of things more, but I think on the passive side or even peer-to-peer lending, it's like, well, it's just for a short term or it's just for a little while. And so we lose that a little bit, that like protection of our own hard work and our own capital. And it's just as important either direction. So it should be an equal amount of energy spent, whether you're buying that asset with $150,000 or you're lending someone $150,000. It should be the same. Hopefully that makes sense. Yeah.
Question popped up. That's a great question. Eve there asking about what kind of lawyer should you go to? A securities lawyer is the best. Like Natasha said earlier, just because you're doing a private lend doesn't mean it's not still under securities law. So if you're doing a peer-to-peer, even if you're going to do a promissory note, which there are situations out there, like we're not saying there isn't a situation where it doesn't make sense. It still falls within the securities law mindset. So securities lawyer, all the big firms have them. There are a lot of lawyers that kind of delve into a little bit of securities law. A lot of corporate lawyers have some securities background or some understanding. So you could potentially get a corporate lawyer that has a lot of experience with securities, but generally speaking, your best bet is to go with someone who's specializes in securities. It's worth the time, it's worth the energy. The harder it is for you to earn your money, the harder it should be for you to review and make sure that you're comfortable with it. So that's one that definitely worth the time and energy.
And if, you know, the group is not willing to give you the time to get that legal review done, like that means there's some major urgency there too. Like what does that tell you? I don't know. I mean, there are deadlines of things you have to consider, but you should have the time to be able to get legal review done. In the guide, there is the list of questions to ask before investing. There's just a couple I wanted to point out in the guide that I pretty well covered most of them, but there's two here that I haven't mentioned that also I'm always surprised I don't ever get asked. How do we get compensated? So for WealthShare, we talk a lot about, okay, here's our strategy. Here's our, you know, what we're investing in, what the opportunity is for you. Here's how we're going to make returns. I always bring up how we get compensated, but very rarely does anyone ask me. And very rarely am I, so that means the other way around. If these people are out there investing with other groups, they're probably not asking that question either. Because how the individual gets compensated is critical to how you'll be prioritized in your returns and how the fund is going to make money or the group or whoever it is. And there is a very wide range of what that answer might be. So for us, we get paid with a few different ways. One is a general management fee that we have of the fund. We also have an acquisition fee and a financing fee because those are very heavy workload times. And those really, though, just keep the lights on for us. Those are not fees that are going to have us retiring anytime soon. Those are just for us to operate. What's really in it for us in the long run, which is what I think people should be asking us, is about our long-term sort of performance bonus goal that we have. So in our offering, do I have it up here? I don't think I do. I'm not in the right presentation. In our offering, you will see that we have an 8 to 12% projected return. So 12% is our goal. We always try to hit 12% when we're analyzing our assets and taking into account everything it takes to manage not just the property, but WealthShare as well. And we're trying to hit 12% with that asset. So if we can't hit that number, we're kind of moving on to the next property or needing to rework the numbers to hit that 12%. We have in our offering what's called an 8% preferred return. And then in hand with that comes a performance bonus. So if we hit an 8% preferred return and there's a cash distribution that year, us as the management team would get a 20% performance bonus of that cash distribution. This is a long-term goal for us, though, because we're in the middle of building a company right now. There is no large distributions every year, but that's what's in it for us in the long run. That's what our long-term sort of, goal is for us. But that could be very different. There is all kinds of different things out there. There's management fees out there that are, flat fees a month that are very high numbers. There is, split of 50-50 or 70-30 or 60-40. There's all kinds of different things out there. So asking the group, how are they getting compensated is really, really important for you to understand. And does that seem fair? And also what kind of protection do you have in there as the investor, or where does that put you in line, right? So thinking about how they're going to get compensated and asking that, I think, is really important.
Yeah, I just want to jump in right there really quickly. Like, I think we live in this really interesting time where we get fine print sent almost daily. If you're on a smartphone, you get the fine print literally 10 times a day. But there's a reason why that saying is read the fine print. I've seen such a wide range of things from there's an offering out there. I think he's charging $35,000 a month on top of fees, on top of everything else. So you got to raise $500,000 just to pay the operator. I mean, just to pay him. And so there's a reason why read the fine print is a saying. And I don't know, I would never suggest anyone's doing anything maliciously, but we get inundated with fine print, so it's very easy to kind of just send it down the table and not spend time on it. But there's also offerings out there where the team gets paid before the investors, like it's an actual priority. Like there's a lot of different ways that it can get shaken out, and just because it's gone through a security lawyer doesn't mean that that they've put the investor in a preferred position. And so
True. Taking
the time on that is really, really important, because there is so many different ways to go about it. I mean, limitless almost. So taking that time there and reading the fine print, as the saying goes, it's there for a reason.
Yeah, it's there for a reason. It can be overwhelming. I've had some investors say, "Oh my God, Natasha, this is too much to read. Like, can't you just send me a simple 1-page document? I'll just send you the money." No, we cannot do that. Do not send me any money. They like us, they trust us, but it's too much, right? And so that's when you should have someone else definitely looking at it on your behalf, especially if you're busy and you got a lot going on. And that brings me to kind of the very last thing, which is more sort of in line with the gut check thing. But do you like this group? Do you believe in what they're doing? I think most people that I've asked why they're investing with us, that comes up. They know, like, and trust us, and they believe in what we're doing. And so that doesn't mean things aren't going to go wrong. That doesn't mean we're not going to have hiccups and things along the way. But does that feel right to you? Does it seem like someone that kind of aligns with your values? And that's not the same for everybody. And then the last thing is, are they an individual or a group who only points out what goes right? Ask what has gone wrong, ask what, things they have learned. And that kind of goes in the sales world a little bit too. As most of you know, I'm a realtor as well. And there's realtors who will only point out everything great about a property, right? It's the same thing. Like, if you're only pointing out what's good and what's great, you're being sold to. And don't get me wrong, we are raising money here too. We are trying to share and sell what we love about WealthShare, but We want to do that as openly and honestly as possible with what's good and great and what's difficult and challenging and what we're learning along the way. And a lot of what we've learned, we wouldn't have known without going down this path as well, which is why we're sharing that with you guys tonight.
Yeah, and just to add to that point before, like I think you read a lot of investing books, whether it's real estate, whether it's whatever else, you'll see a very common trend through them all, which is you bet on the person, and then you bet on what they're doing, right? We've all looked at a ton of properties and a ton of things, and if you don't believe in the person behind it, it's almost irrelevant. Almost every really major successful investor, that's where they start. Long-term people, long-term plans, as our newest trustee, Sean Wilson, reminds me often. And one of the reasons why we got along so well together at the beginning. And it's the people, right? Like the people are going to pivot when there's problems. The people are going to respond. You bet on good people, and you'll be in good shape with your investments more often than not.
Mm-hmm. Yeah, that's awesome. Any questions, thoughts? We, like I said, want to be a resource. So if anyone needs anything, please reach out. If you're interested, of course, in learning more about WealthShare, if you're not already with us, we would love to meet with you and learn more about your real estate goals. We are really a community here. We, all are available to our investors. We make ourselves very available. I also want to introduce Michael here with us this evening. He's just joined our team as our investor relations support. So we're really excited to have Michael on the team with us. And good, thanks, Susan. And so any one of us are here to help at any time, and we'd love to have you on board if you're not already. We have some exciting opportunities in the wings for 2025, and are just excited to continue to grow and share what we're doing. So I hope that was very valuable. Does anyone have anything else to add?
No, just more to that. You might hear from Michael in the coming days. He's been great to work with. He's onboarding with us and is based here in Calgary as well, which is great for the team. We're really excited for next year. We've kind of gotten through, say this a lot, but we've kind of gotten through the startup phase, and now we're into the growth phase of WealthShare. We've established ourselves in the market and in Calgary, and with a portfolio that we're really excited about. But now it's taking that next step and growing the team, growing the portfolio, and delivering those returns on a dependable yearly basis from here on out.
Mm-hmm. Yeah, I think when we started this a few years ago, it was really hard to know, to see where it would go, right? Like it was something we were all very aligned on, but we've made incredible progress. We could not have done it without our investors. The support we have had has been incredible, and we thank you guys so much. And are just excited to continue. So we got some exciting things hopefully lined up for next year, and I'm sure we'll see you guys hopefully soon.
Yeah, I last little note, which is maybe more for a more casual, maybe a wine session or something. We picked a very interesting time to start WealthShare. You saw the bond market, the 20 years before we launched WealthShare, it was a straight line. And within weeks of launching WealthShare, it turned into a ping pong match, and it was bouncing up and down and going all around. And then the last year, we've seen, unfortunately, a lot of these offerings go sideways, and all this stuff. And we've had, I don't know how many stories we could tell about the properties we've acquired and everything like that. So we might have to have a glass of wine session where we go over some of these stories and talk candidly about what we've learned. And also, I hope, build trust that we've encountered some really interesting stuff, but we've been able to put our heads down and walk through the wind a little bit and get to the other side of that. So I think that'll be a fun maybe one of our in-person events coming up. If you're in town, to come join us, we'll uncork a few bottles of wine and go through some of those.
Yeah, I haven't gone great for nothing.
Yeah, there's some stories in there. It's been fun.
Yes, Carmen.
Yes, we do, Carmen.
Actually inspired us, Carmen.
Yeah.
We felt really inspired. So Carmen actually hosted Rodney and I last week at her home in
It was amazing.
Kelowna, with a small meetup type of group in Kelowna, and Carmen, we were inspired. We're actually going to host these come to hopefully some individuals' homes and have these smaller meetup type of events. So if that's of interest to anyone, please let us know. We'll travel for that. We want to get in the community. We love our kind of grassroots sort of story, and we want to continue with that. So if you'd like us to come hang out and, we can talk and share real estate, we would love to do that as well. So thanks, Carmen, for having us. That was a lot of fun.
Yeah.
Food and wine. It's always more fun with food and wine and in person, right?
Yeah, exactly.
Awesome. Well, thanks everybody.
Yes, thanks so much.
See you. Have a great holiday season as well. Somewhere in Invermere, please.
Perfect.
That's great. I'm there, Deanna.
Yeah.
Sounds good. Thanks so
everybody.
much, Mark. Thanks, everybody. Good to see you. Good to see you, Ryan.
Have a good rest of your night.
Good night, everybody.